The London Stock Exchange has a problem. More and more retail investors don't want to invest in London stocks, and there's a declining number of companies that want to list here. Take the fintech firm Wise, which is leaving the exchange to move its primary listing to New York. Some have warned that without urgent attention, the UK's premier stock exchange could soon fall into obscurity, becoming a backwater for equities. But just how bad is the situation? Here are 6 problems with London's stock market. Number 1. Poor performance. Since the start of the COVID pandemic, the UK stock market has significantly underperformed the US. The FTSE 350 index, which measures the growth in stock prices of the 350 biggest listed firms in the UK, has risen 38% over the past 5 years. But the S&P 500, an index of the top 500 US companies, has climbed at more than double that rate, rocketing some 92% over the same period. Number 2. Lack of IPOs. The number of IPOs, or initial public offerings, has declined massively in London as British firms increasingly turn to New York to float their shares on the stock market. Just 18 companies made their debut on the London Stock Exchange in 2024, a huge decline from the 108 that joined in 2021. Number 3. Poor valuations. Another big problem for the London Stock Exchange is that firms are valued at lower multiples than their US rivals. In particular, the price to earnings ratio, that's the value of a company relative to how much profit it is making. UK stocks are trading at a price to earnings ratio of 12 compared to as much as 22 for the US. One recent study found Britain's top 100 companies would be worth as much as £500 billion more if they were listed in the US. Number 4. Declining market share. In 2000, the UK accounted for 11% of the major stocks traded around the world. Now that figure has slumped to just 3.7% amid a growing dominance of the New York stock market. Number 5. Continued outflows. A growing number of investors are taking their money out of the UK stocks rather than pouring money into them. UK equities have seen net negative outflows nearly every month for the past 3 years. That has led to more than £40 billion in net outflows from UK-focused funds since 2020. And number 6. High taxes. It costs more to buy and sell shares in the UK than it does in the US or the rest of Europe. That's because shares are subject to stamp duty, a tax which charges 0.5% on the value of the shares every time they are passed on. No such tax exists in the US. For the latest stock market news, head over to cityam.com.